The book we will be discussing today is Common Sense on Mutual Funds, written by John Bogle, a legendary figure in the American fund industry. Before we get started, please hit on the subscribe button below to stay updated. Among all investment books, Common Sense on Mutual Funds may be the most relevant to ordinary investors. In this book, the author describes a simple, long-term, easy-to-learn investment method. This method has been proven by a century of data from the American market to be effective in the long term, with returns far exceeding fixed deposits. What is this magical method? Let me give you an analogy. Suppose you have a hobby of rolling snowballs. In winter, when it snows heavily, you find a long slope covered with wet snow. You start by making a small snowball with your hands and then push it down the slope slowly. During this process, the snowball continues to absorb new snow, growing bigger and bigger. This snowball rolling process is akin to the investment process. When you invest in the stock of a good listed company, such as Kwaichao Mutai, it is like entrusting the company to help you roll the snowball, growing your principal over time. But what kind of companies have the best snowball rolling ability? This selection process is very professional. Moreover, a company's ability to roll the snowball constantly changes. A company that was great last year might not be as good this year. If you entrust a company, you must constantly track and monitor it, which is very time-consuming and energy-draining, something most people cannot afford. At this point, someone offers a very simple solution. Set up a plan to select a few hundred relatively reliable companies to roll snowballs for you. If some companies fail along the way, they are periodically eliminated and replaced with new ones. So, you just need to entrust this plan with the snowball rolling task and not worry about anything else. Each company here represents a stock of a listed company, and this plan that selects a few hundred companies is called an index fund. For example, the S&P 500 index in the US comprises 500 companies. When you buy an index fund, it is like simultaneously entrusting several hundred listed companies to roll snowballs for you. Since this method appears effortless and requires no active intervention after purchase, this long-term holding of index funds is called passive investing. The author of this book, John Bogle, is the first person globally to invent index funds, providing ordinary investors with an excellent investment tool. Throughout his life, he received many honors, even being highly praised by Warren Buffett. At the 2017 Berkshire Hathaway shareholders meeting, Buffett praised John Bogle greatly, saying, "John Bogle has done more for American investors than any other individual." When Bogle started offering index funds, almost no one on Wall Street was willing to help because index funds reduced investment fees and Wall Street's profits. Today, index funds have brought returns to investors higher than almost any other financial product. This book, written specifically for the general public, is John Bogle's most classic work, using a wealth of convincing data and evidence to comprehensively expound on his core investment philosophy. In the following time, I will divide the interpretation into 3 parts. The first part explains why passive investing has advantages and how to practice it. The second part discusses what self-cultivation a qualified fund investor should have. The third part explains how Bogle's investment philosophy combines with practical situations. Part 1. Let's start with the first part. Why passive investing has advantages and how to practice passive investing. Just now, we briefly introduced passive investing using the snowball analogy. Now, let's explain it in more detail. Broadly speaking, investments can be divided into 2 types: active investing and passive investing. Active investing involves conducting research, selecting a stock you believe is good, and choosing the right timing to buy and sell. Since this process requires many active decisions, it is called active investing. Warren Buffett is a representative of this approach. On the contrary, passive investing involves neither stock selection nor timing selection. It uses the most straightforward method of buying a basket of stocks and holding them for years or even decades. You might underestimate this seemingly simple investment method, but John Bogle tells us that by using this method alone, you can outperform most professional fund managers. So, what should passive investors buy? John Bogle says you should buy index funds. Let's first explain a concept: mutual funds. As mentioned in the book's title, mutual funds are publicly offered funds. These funds are publicly raised from society and invest in securities, futures, bonds, and other financial instruments. Public funds can be divided into many categories, and index funds are one of them. In the U.S., index funds account for 1/3 of the total public funds. What does index mean in index funds? A stock market index is usually calculated by a third-party institution using a simple mathematical method. Since this investment method does not involve stock selection and allows one-click purchasing, index funds have become the primary tool for passive investing. What are the benefits of passive investing through index funds? Bogle points out several crucial advantages. Let's look at them one by one. Firstly, long-term returns are high. Over the long term, among all different asset classes such as stocks, bonds, and gold, stocks have the highest long-term returns. In the past 200 years in the U.S., the long-term annualized return on stocks has been around 7%. This return is twice as high as bonds and much higher than gold. Over the long term, the return on gold is almost negligible. So, why do stocks have the highest investment returns? John Bogle gives us a formula for the sources of stock returns. He believes that, in the long run, stock returns come from two things added together. The first is the dividend yield at the time of purchase, which represents the company's ability to pay dividends. The second is the future earnings growth rate of the listed company. We know that listed companies are usually the most excellent companies in a country's economic system. Their average earnings growth rate must exceed the country's overall economic growth rate. Therefore, as long as a country's economy is on an upward trajectory, buying and holding listed companies in the long term will yield good returns. Besides long-term returns, John Bogle believes passive investing has two other significant benefits: low costs and no timing selection, meaning you don't need to choose when to buy and sell stocks. Regarding low costs, let's look at an example. Suppose you now have two investment options. Plan A involves buying an existing fund that invests 35% in U.S. bonds and 65% in U.S. S&P 500 stocks. Plan B also involves buying 35% U.S. bonds and 65% U.S. S&P 500 stocks, but instead of buying the existing fund, you buy a bond index fund and an S&P 500 index fund. This plan invests in the same things, but index funds have lower fees, saving 0.9% annually. Assuming you invested $10,000 in both plans in 1947, after 50 years, with Plan A, your $10,000 would become $1.08 million. With Plan B, your $10,000 would become $1.615 million, nearly 50% more than Plan A's $1.08 million. Since both plans invest in the same things, this significant difference in results comes entirely from the slight annual fee difference of 0.9%. This example shows us that reducing costs is crucial in long-term investing. John Bogle even considers cost reduction the top priority in long-term investing. Any slight cost difference will be magnified over time in long-term investments. After discussing the advantage of low costs, let's look at the third advantage of passive investing: not timing the market. Not timing the market is easy to understand because index funds continuously hold stocks that make up the index without selling them, eliminating the need to choose the timing. But does not timing the market provide an advantage? We might ask the reverse: is market timing an advantage or a disadvantage? The book lists the market timing abilities of the media, fund managers, and ordinary fund investors, showing that most of the time, they yield negative returns. Therefore, not timing the market becomes an advantage. Let's look at the media's market timing. The book cites examples from two top American magazines. On August 13, 1979, Businessweek published a cover story titled "The Death of Equities," which was bearish on stocks. When the article was published, the Dow Jones Index was at 840 points, near the bottom. By May 1983, the market had risen by almost 50%. Another even more bizarre story involves Time magazine's September 26, 1988, issue, which had a cover story titled "Buy Stocks. No Way," with a giant bear on the cover. When the article was published, the Dow Jones Index was around 2,000 points. After that, the index rose to 9,000 points. Since even top magazines can't get it right, what about smaller media outlets? Bogle concludes that the media's market timing is often unreliable. What about professional fund managers and their timing abilities? We can observe the diligence of fund managers in timing through an objective statistical indicator, turnover rate, the frequency of buying and selling stocks within a given time. A higher turnover rate indicates that fund managers are more active in timing operations. In the 1940s to 1960s, American stock fund managers had an average annual turnover rate of 17%, meaning it took over 5 years to completely change the stocks. By 1997, the turnover rate had risen to 85%. 10 years later, by 2007, it had increased to 105%, meaning all stocks were changed in less than a year. Data shows that over several decades, American fund managers became increasingly active in market timing, with more frequent operations. But the result? Unfortunately, there is no evidence that the management level of American stock funds improved with increased turnover rates. On the contrary, the higher costs from increased turnover hurt fund performance. Finally, let's look at the market timing abilities of ordinary fund investors. Many retail investors buy funds intending to time their purchases and redemptions. What do the data tell us? From 1975 to the first quarter of 1981, investors continuously withdrew funds from public funds for 24 consecutive quarters, withdrawing nearly half of the initial scale. After many people withdrew, a new bull market began. In the third quarter of 1982, the market started to warm up, reaching a peak in 1987. In the first 9 months of 1987, investors injected $28 billion into public funds, only to see the stock market crash in October. Ordinary fund investors' market timing operations often result in negative returns. In the fund industry, there is a saying, "Good to sell, not good to do. Good to do, not good to sell." This means that when funds are selling well and investors are rushing to buy, it's often not a good time to invest. When funds are hard to sell and investors are reluctant to invest, it's often a good time to invest. Let's review the first part we discussed today, focusing on the advantages of passive investing and how to practice passive investing. The main method of passive investing is to buy and hold index funds. Its benefits include at least 3 points. First, stocks are the highest yielding asset class in the long run. Second, index funds have very low costs compared to other funds, which can become significant advantages over time. Third, passive investing does not involve market timing, which is an advantage because most market timing actions by the media, fund managers, and ordinary fund investors are losses rather than gains. In fact, over the long term, index funds can outperform most actively managed fund managers. Part 2. Now, let's move on to the second part of today's discussion. What self-cultivation a qualified fund investor should have. In this book, John Bogle offers several rules and suggestions for fund investors, which I have summarized into the self-cultivation of a fund investor. To become a qualified fund investor, you need at least 3 points of self-cultivation. The first self-cultivation is not to blindly believe in a fund's past performance. If you do a small survey and ask people around you what their basis for buying a fund is, you might get answers like, "The fund performed well last year," or "the fund manager is famous." In fact, historical performance and the fame of the fund manager are the most frequently considered indicators for retail investors when buying funds. These are also the points most emphasized by fund sales institutions during the sales process. However, John Bogle clearly states in this book, do not overestimate the importance of a fund's historical performance, and be especially wary of star fund managers. The book provides detailed research data. It first divides funds based on their performance in the 1970s into 4 groups. Then, it examines their performance in the next decade, the 1980s. It finds that the group of funds with the best performance in the 1970s had an average annual return 4.8 percentage points higher than the index, but in the 1980s, it underperformed the benchmark by 1 percentage point, showing a significant mean reversion tendency. In other words, the better the past performance, the worse the future performance. This pattern repeated from the 1980s to the 1990s and again from the 1990s to 2009. Since we cannot rely on past performance to choose funds, how should we select them? John Bogle believes that relying solely on a fund's historical performance to make decisions is unreliable. However, historical performance is not entirely useless. We should use it to assess a fund manager's consistency and risk level. Consistency has 2 meanings. One is whether the fund manager's actions align with their words. If a fund manager claims to be a value investor but buys poor quality stocks, the fund is not trustworthy. The other meaning is whether the fund's investment style changes frequently. If it switches between buying large cap and small cap stocks, the fund's performance is questionable. As for risk level, it refers to the fund's volatility in its historical performance and whether it can control risks when its net value drops from a peak. In summary, we should not select funds based on past performance, but can use historical performance to exclude unreliable funds. The second self-cultivation of a qualified fund investor is to understand the inverse relationship between asset scale and performance. In other words, the larger the asset scale, the less likely it is to achieve good performance. Asset scale is an easily overlooked but crucial factor for investors. In the fund industry, there is a saying, "Scale is the enemy of performance." The larger the scale, the harder it is to achieve returns above the market average. From time to time, very popular funds with hundreds of billions in scale are issued. However, these funds often perform poorly. Therefore, be cautious with extremely large popular funds. Additionally, John Bogle believes that ordinary people should not buy too many fund varieties. Remember the one-hand principle, meaning buying no more than 5 funds, or even 2 to 3 funds is enough. The third self-cultivation of a fund investor is to have a long-term investment plan. Speaking of index funds, we can see that the market has many stock indices. Different indices correspond to different index funds. So, when investing, does it make a difference which index we choose? John Bogle's answer is that there are differences in the short term, but almost none in the long term. He studied 2 typical indices in the U.S. market, the S&P 500 index, representing large stocks, and the Wilshire 5000 index, representing small stocks. Although there are differences in their performance over short cycles of 3 to 5 years, their total returns over the long cycle from 1970 onward are the same. Both earned an average annual return of 13.7%. To summarize the second part, we discussed the self-cultivation of a qualified fund investor. It's essential to note that we should not select funds based solely on past performance, which is very unreliable. You should choose funds that align with your investment philosophy, exhibit consistency, and have good risk control in their past performance. Part 3. First, in the past decade. Index funds have become increasingly well known, becoming an investment tool for more and more ordinary people. Taking the US as an example, the past decade has seen the prosperity of index funds, with their scale growing rapidly each year. By the end of 2017, the US mutual fund market was worth $18.7 trillion, with index funds accounting for over one-third. All this began with the creation of the first index fund by the book's author, John Bogle, in 1975. In the decades since then, people have discovered that index funds allow ordinary people to invest easily and share in the long-term economic growth of a country, gaining increasing popularity. In fact, besides the three significant advantages of passive investing mentioned earlier, there are two additional benefits worth noting that Bogle did not mention in his book. One extra advantage is that index funds do not rely on any star fund managers. The goal of index funds is to achieve the same investment returns as the stock index, so they do not require human intelligence to select stocks or time the market. They only need to make corresponding adjustments periodically based on the index components. This minimizes their reliance on individuals. Changing fund managers midway does not affect the performance of index funds. If you plan to invest for more than 10 years, this stability, which does not rely on individuals, is very important. The second additional advantage is that index funds inherently contain the investment philosophy of buying more of the best companies. Stock indices are usually compiled using a market capitalization-weighted method. This means that the larger a company's market value, the higher its weight in the index. Correspondingly, when index funds buy the component stocks, they buy more shares of the larger companies. This effect is due to the index's inherent survival of the fittest principle, allowing index funds to buy more shares of high-quality companies. As we mentioned, besides the three benefits discussed in the book, index funds have two additional advantages. They do not rely on individuals and embody the investment philosophy of survival of the fittest. Understanding these two extra advantages makes you more professional than most people. Conclusion. Finally, I want to add some personal thoughts and suggestions on this book from a professional investor's perspective. The author talks about the advantages of passive investing. So, should everyone invest in index funds? Let's review the theoretical foundations of passive and active investing. The foundation of passive investing is the belief that markets are fully efficient, meaning all information is already reflected in stock prices. Therefore, you should not try to outperform the market. Following the market is good enough. The foundation of active investing is the belief that markets are not fully efficient, meaning some information is not yet reflected in stock prices. Discovering this information can yield excess returns. Therefore, through one's intelligence and effort, there is a chance to achieve returns higher than the market average by selecting stocks and timing the market. Thus, we can draw a coordinate system. The higher the market efficiency, the more we tend to passive investing. The lower the market efficiency, the more we tend to active investing. We know that the US stock market has the highest efficiency globally, so recent decades of practice have shown that index funds are increasingly favored by many people. However, stock markets have their characteristics. In the past years, the market has often shown short bull markets and long bear markets, with no long-term bull market trend. Additionally, retail investors still dominate the market, making it highly inefficient, providing many opportunities for active investing. In this book, John Bogle's common sense is crucial. I suggest we think more deeply about the issues this way. For retail investors, if you don't have enough time, energy, and professional skills, you have two choices. One is to invest in index funds, preferably through dollar-cost averaging, investing a fixed amount of money each month to lower costs and smooth out volatility. This choice is suitable for most people and is my most recommended method. The other choice is to buy actively managed funds after careful selection, as the market's inefficiency indeed provides a stage for active investing. But you need to know how to select funds, not just based on past performance. This choice is only suitable for a small number of people with such ability. For professionals in the investment industry, on the one hand, the current market provides space for active investment management. On the other hand, the development of index funds is not an enemy of active investment management. On the contrary, in many active management strategies, index funds can also be a good investment tool. These are my personal thoughts and suggestions for your reference. The original book link is attached at the end for further reading. You can also click the share button below the video to share this book with your friends. Congratulations, you've just finished another book.